Okay, I think we'll get started now. I got just 1 o'clock, 1:01 Central. So let me welcome everyone this afternoon. It is Monday, January 14th. Welcome. Happy New Year. This is our second, I think this is our second webinar of the new year at Discover Options. So I'm glad to be here. Let me start. Can I get an audio check? We're actually using a little bit new, or we're on a new webinar service here, and I just want to make sure that our audio is working out okay before I go through this and realize after 20 minutes there's no audio. Okay, great. Awesome. It sounds like we have audio. All right, I am Steve Papale, and I am with Discover Options. I'm one of the mentors there. I've been there actually for This is beginning of my 5th year there, I think, 5 years. I also am the president of Papale Capital Management Company. We are a registered investment advisor. So I am glad to be here today. Our topic is, I thought with the new year, and I've been getting a couple of requests over the holidays about some trading mistakes, and we've been putting out a few fires over some things with over the past year. So I thought we might start out this year going over some of the top 10 trading mistakes, and hopefully mistakes that we'll avoid. So in reality, though, I kind of based a lot of this on my own personal experience of 25 years of trading. I couldn't stop at 10, so there's actually going to be a bonus 10. So there's going to be more like 20. So plenty of mistakes we're going to review today. Hopefully this will help you as we go, and myself too, as we go through the new trading year. Give us just a good base here to try to think about things not to do. And I've seen every one of these, believe it or not. If you got questions, this is going to be more about me kind of sharing information. We do lots of different webinars here. Lots of times I'll share the desktop, and sometimes I can't see chats and things like that. But jump in with any kind of question. I'll read the chats, and I'll answer them as they come up. This is pretty casual right here today, so there'll be plenty of time here, I think, for questions. So just jump in with any kind of question you might have. I'll do my best to answer it right on the spot. So, all right, let's get going. I got Jeremy here keeping an eye to make sure I don't blow up the system. So, okay, we got to go through this. This is all just a legal disclaimer, both for we have to release. So go ahead and read that, and I'll just kind of move through that. Anyway, Happy New Year, as I said. It's good to be back. It's been about a month, I think, since I did my last webinar. We had some time off and stuff, so we've had obviously a lot of activity in the market at the end of last year. Whether you trade options or whether you're a stock trader or whether you're just a market observer, there certainly was a lot to watch the last couple of weeks of last year. We did make it to the fiscal cliff situation by the hair of our chin, and at least for now. I think we have another situation with the debt coming up here in a couple of months, but the market sure likes it. And we saw that VIX fall like crazy, starting around when it became clear December 31, and then obviously tomorrow, January 2nd, the VIX really cratered. In fact, it was the biggest drop percentage-wise in history. It went from around 22, I think, to 14. Huge fall in the VIX. So clearly the fear was gone, and people no longer, got out of their option positions or hedges. So that was kind of interesting to watch. I didn't realize that was the biggest drop in history either. That was kind of that was interesting. We got some bad sound. Okay, Peter, try to come back. Maybe it's just yours. Hopefully the sound on everyone else's sounds okay. Let me go back here and make sure that we're not getting bad sound. I got one guy saying sound is broken. This guy's good sound, sounds good. All right, I think I think it may be. I'm getting good sound mostly. So if you're getting bad sound or broken sound, try maybe to call back in. It sounds like that may be a specific connection to any given end user. Hopefully you'll get that corrected. Anyway, I'm looking forward to a great new year. There's a little echo. Wow. I wondered if I'm going to try something here. Hold on one sec, folks. I'm going to try one thing. Okay, let me see if this helps. All right, I'm off. That changed things a little bit on my end. Hopefully that made it come in a little bit clear. Better. Okay. I work off of Bluetooth a lot. I'm on the phone a lot. So I got rid of that. So maybe that'll help a little bit. Anyway, I'm looking forward to to 2013. I hope we all are. We're excited. Last year we had pretty good year, and we're looking forward to a good year again in 2013. We're here to help. I'm here to help. I've been a mentor here for a long, 5 years. We manage some client money and things, but our primary job here is to help educate traders, investors, managers, whatever. And if you have any suggestions for topics, send me an email at this email address below. I love to get ideas from people so I can give you, what you're interested in. I have a list of topics that we kind of go over. We go over strategies, we go over theory, we go over stuff like we're going to do today. But if there's a specific topic that anybody's interested in doing, send me an email, and I can get it on the webinar, schedule. So I'd love to hear from anybody and come up with. I want to make sure that I give listeners what they want. You guys have, I'm sure, tight schedules, and I want to make sure that I'm not wasting all your time. So please feel free to do that. All right, without any further ado, let's go ahead and get the top 10. So we're going to go over some top 10 trading mistakes to avoid. Okay, and I don't have a button like this on my computer, but sometimes I wish I did. But all right. Number 10, we're going to do this like Letterman, like late night. Number 10, try to make money too soon. Try to make money too soon. In our program, in our mentoring program, we go through a very specific, and for those of you that have been through this, you'll know what I'm talking about. We go through a specific plan, educational process. But once we get through the material, we encourage folks to start trading, and they go through the back trader, the back testing. We test this stuff in back trader. We practice it, and then we tell them to start to scrimmage. We tell traders start scrimmaging, and inevitably, when they start making money on a very small scale, they ramp size up way too much, because the money that they're starting to make on the practice account, which is generally very small, and I encourage it to be very small, isn't enough. And my suggestion, or my idea, or what I try to drive home is, don't worry about the money initially. We're not here to make money initially. All we're trying to do is learn a strategy. We're not trying to make money. The money will come. And I've seen over and over again where guys get a little success early on, and they ramp up size by 3, 4, 5x or whatever it might be, and they'll get a bump in the road, and inevitably their emotions and their focus changes when they're trading larger dollars, and things go to heck fast. So that's a problem in trying to make money too soon. So we can all avoid that. The money will come. The money will come. Number 9. One of my favorites, pay attention to the talking heads. There's an awful lot of people out there, channels, radio shows talking about the markets. It's everywhere. And I mean, we've got CNBC, we've got Bloomberg, we got it all. And they've all got their own opinion. And if you put, 5 people in a room, they're all going to have 5 different opinions. So please, try to, tune some of that out. It can be very distracting, and it can really start to bend your mind in ways that might not be good for your trading. So I would try to encourage you to turn off CNBC a lot. I don't have it on 90% of the time. I just focus on the trade and what our plan is, and watch the markets and kind of manage the trade. The markets I can't do too much about, but I can manage the trade. So pay attention to talking head. Try to avoid that. Number 8, let your emotions rule. Let your emotions rule. Here's Homer here. We're in a very emotional business. And when you're dealing with money, it can be very emotional. That's why we have a trading plan ahead of time, and that's why we try to focus purely on the mechanics of what we're doing once the trade is on. Some of the problems that we run into are trades that are made based on emotion. So please try to get out of emotion. I know that sometimes that's easier said than done, but there's ways that you can do that by preparing ahead of time and come up with a trading plan and becoming very mechanized in how we execute the plan. Number 7, not getting out at the worst time. Okay, and let me explain what I mean by this. Trading is a business, and any business has a certain cost, an embedded cost of doing business. Okay, if I'm starting a store, I've got costs associated with store startup, and there's going to be certain inventory damage control and loss and all that kind of stuff that you got to work into your business plan. Inevitably, you will have a trade on, and you will get out at the absolute bottom of the market if you're long, or the absolute top of the market if you're short. That's part of the business. I've done it. Every trader out there has done it. And you're going to have to just kind of accept that that's part of the trading business itself. So people that get too frustrated when they get out at the worst possible time, I try to encourage them that, look, you have to not think of it as that you're getting out at the bottom or the top, depending on what side of the market you're in. But it's just simply a cost of business. It's just simply a cost of business. So if you're trying to avoid getting out at the worst time, and none of us want to, try to think of it like that. It's really a cost of business. Number 6, legging into spreads. Okay, that's not a carrot there. That's not a leg there. That's actually a carrot. It's very tempting to leg into spreads for spread traders out there, and I get this an awful lot. Is when we're doing, whether it be a condor, butterfly, a back spread, put spread, call spread, you name it, calendar. People have an interest in legging into these things, and I universally say don't leg into these spreads. It's just not worth it. You're taking directional risk when you're not maybe interested in trading directionally. So don't leg into spreads. And generally, you can get pretty tight markets on these spreads anyway, so you don't need the undue risk and the undue aggravation of having to leg into them. So it's just it's much better on your mind, and it's much better generally on your bottom line if you just do not leg into these spreads. Don't leg into spreads. Number 5, be stubborn. If you wanna lose money and blow out of the business quickly, be very stubborn. I've known plenty of guys out there that don't take advice, don't take instruction very well. They believe they're right all the time. They're just stubborn, and that's not exactly a quality that you're going to want to have, not only in trading but generally. So be stubborn. And this is to avoid, by the way. I'm not telling you to be stubborn. Number 4, believe the statistics in the short run. Okay? Believe the statistics in the short run. And what I mean by that is a lot of our strategies, not just our strategies, but many trading strategies are based on long-run statistical expectation.
Okay, our butterflies are based on that. Our condors are based on that. For those of you that trade, some of you that trade directionally, you may have that embedded in your trading plan. But the statistics are based on the long run averages. Okay, anything can happen in the short run, and what I mean by the short run is months. Okay, it could be 2, could be 3, 4 months, and we've had situations where guys have had 2 or 3 losing months in a row, and they completely revamp their trading plan. We certainly want to look into if there's an issue going on, executing or some other thing, but you have to let the statistics work themselves out over the long run. Most of these statistically based strategies that we use, they self-adjust, and over the long run, they sort of have to work out. So you got to give them time. You got to give them time. Don't base everything on, you know, a month or 2 months. Okay. Got a question here. To leg into a spread means to cut only one leg of the spread and keep the other one open. What I mean by legging into a spread, Philip, is if I assume I have a call spread. Okay, I'm going to buy a call spread, for example. That means I'm going to buy a more expensive call, and I'm going to sell a less expensive call. Well, what I might do is buy the call that I need to buy, okay, and I might buy that, and then once I get filled on that call, I'm going to go out and try to sell the other call. So I've essentially bought the call individually, and then I'll go out and I'll sell the call that I need to sell. Okay, that's legging into a spread. Okay, the problem with legging into a spread is when I buy that call, what I've essentially done is created myself a directional position, a much bigger directional position maybe than I wanted. Okay, so if I need to sell a call after I have to make that initial call purchase to complete my spread, I'm going to need that market to either stay where it is or rally so I can get a better price on that call that I want to sell. If the market goes down when I'm long the call only, then I'm going to get a worse fill on that call that I'm trying to sell. So you effectively are taking a directional bet when you leg into these spreads, and it can become very, not only just a pain, but you can really get caught if the market turns against you. Okay, so that's what I mean about legging into a spread. All right, number 3, blindly trust the technology. Okay, everything today is technology based. I mean, almost all trading now is done on the computer. When I got started, it was all pit traded stuff, and we were all standing in the crowd yelling and screaming, and we were writing down on pieces of paper. That's all sort of gone now, or it's quickly going away. So what you have is a technology-based execution system, a technology-based transaction. And I've had many instances when my technology has failed. Okay, I can put all the orders in, I can do all the research, I can do all of that. But if my technology fails, I'm still going to get in big trouble. There was one situation, this happened about 2 years ago, where we had some butterflies in our accounts, and we were offered out on these butterflies. And I forget what our offer was. I think it was around, let's just say it's $20. And we had multiple accounts offering butterflies at $20. And I'm watching the market, and it trades 20 1/4. Okay, so it traded above our offer price. Well, we didn't get any fills. So I called the desk and said, "What's the story? How come we didn't? How could it trade above our offer? We should have been filled at 20." Well, they had no explanation. They kind of passed me through to somebody else. It got cut off a couple times. Meanwhile, we're still long these butterflies. And the point of what happened was is somehow the communication between my computer, I guess, and the execution desk was disrupted. So what we effectively had to do was close down the order on the computer, go re-enter it, and then turned out we had to leg into each one of these things individually across accounts. It was a real pain, but the point of it is the technology failed. And, you know, it's just part of the game. It doesn't happen all the time. It happens sometimes, but you have to be aware, you know, that you're relying on something that doesn't always work 100% of the time. So, you know, make sure you got a phone number to customer service that works. So that's for sure, that's important. Number 2 is don't trade with a plan. Okay, don't trade with a plan. We spend a lot of time in our mentoring program going over the trading plan. You can learn a lot about the strategies. You can learn a lot about the markets and all that sort of thing. But if you don't really have a trading plan in place, you're going to get yourself in trouble every time. And that not only includes, you know, setting the trade up. That not only includes the structure of the trade, you know, the entry, how you're going to enter the trade, how you're going to manage the risk of the trade, but it also includes the money management portion, how much you're going to allocate to the trade, how your P&Ls are going to look, what your loss points are going to be, your profit targets, all that kind of stuff. It's all covered, it's all important, and it's all, you know, tied together. So you got to have a plan. That also helps take out that emotional piece too. So, you know, if you know what you're going to do under every scenario, you can almost just put it on auto control and not have to worry about it. And it just does, you know, it is what it is, and you kind of just let this thing kind of run itself almost once a trade is on, and it just takes the emotion out of the whole thing, and it just makes you much better at trading and much more successful in the long run. Okay, so if you want to set yourself up for failure, don't trade with a plan. And then number 1 on the first 10 anyway is you're right, the market is wrong. Okay, you're right, the market is wrong. I've had more guys put positions on, hit their stop points that were pre-calculated ahead of time or predetermined ahead of time, and then at the point where they should have taken a loss, decided that the market was totally screwed up, overbought, if they were, you know, short or whatever it would be, and decided that there's no way the market could sustain this rally, and said the market's completely out of whack here. I'm going to ride this thing out, and proceeded to watch this thing run in their face for a lot longer. So the market's always right. The market is always right. You got to just kind of accept that, and know what, you know, get out when you're supposed to get out, and you know, go on to the next trade. Okay. It's a very humbling environment that we sort of work in, and so we have to just kind of recognize that. So, all right, that's kind of the first page. This is all going to be recorded. These webinars are always recorded. Just FYI for those of you that are that may be new on here. I know we get a lot of new people in here every week, so. These are all recorded and archived, and generally they do it pretty quickly. I don't know how quickly, but usually within hours, if not by tomorrow. So you can go on the website, and I think those are archived somewhere on the website. So, all right, well, that's the first 10. Okay, those are the first 10. And again, for those of you, we get a huge cross section of people on these calls. So For those of you that have traded for a long time, probably that stuff is sort of, it may be review. For those of you that are newer traders or maybe have not traded yet, maybe that's something that you might, consider or put on your thought machine or whatever. But those are what I found in the past to be 10 very important problems to avoid, and I've seen every one of them. A lot of them I made myself. So now what I've done here is we got a few others, because you can't just stop at 10. There's a lot more mistakes to make than 10. So we've got the next 5. Okay, the next 5 mistakes to avoid in the trading business. All right. So number 5 is overtrade, and this guy is, I felt like him before, is overtrade. And in our program, we don't run up against this a lot because we have a very well thought out, well-defined trading plan. So we have specific entries and exits. We have, it's all kind of laid out ahead of time, so we're not really overtrading a lot. But it's certainly, based on what you're doing, it could be an issue. Okay, if you're a technical trader and you're getting tons of signals and, I don't know, if it's not being profitable, or if you're trading an environment that's, that you're making these marginal trades that may not be trades that you would normally make, you got to rethink that. I know when I was trading back in the pit, we had tons of guys that would overtrade. I mean, it was ridiculous. Back and then, every trader is trading for an edge. You always have to have an identifiable edge, no matter what you're doing, whether you're trading in the floor, on the pit, or upstairs, whether you're trading directionally, non-directionally, it doesn't matter. There has to be an edge. That's the only reason you're going to trade. Okay, there has to be a profit target, and there has to be a way to capture it. If you can't either identify the profit, and number 2, be able to monetize the profit, there's no reason to trade. There's no reason to make the trade. But time and time again, guys trade even if they necessarily can't get both of those. Trading is kind of a addictive sport. And once you start doing it, it gets a little bit, it's fun, and especially when you're making money. So you have to be very careful that you don't overtrade. And sometimes it's not a big deal if you're not losing a lot of money, but you can surely burn a lot of commissions, and, this guy probably use some sleep. Number 4 is change the rules during the trade. Okay? These are things you want to avoid. Changing the rules during the trade. And I keep going back to the trading plan, but once you decide how you're going to go through this trade, okay, from entry to management to exit, you stick with it. You stick with it. There's an old saying, traders never get smarter during a trade. And I found that to be the case pretty much my entire career. Most of the good thinking in this business, and like most business, comes ahead of time. It comes in the pre-planning and the preparation. It doesn't really come during the execution. Rarely does it happen that way. I mean, I could count on one hand over the years where, in the environment we switched gears, maybe because there was an event or a technology snafu or some kind of weird, volatility spike or something, whatever. But I mean, it just doesn't happen. So stick to the rules. It'll save you a whole lot of stress. Okay. Number 3, don't drink while you're trading. This was an issue back when I started in the business in the 80s and the 90s. I mean, guys were go to lunch and have 3 or 4. Here's a great way to tell if a guy's doing something and drinking. He normally trades 10 lots, and after lunch he comes back and he's starting to throw 100 lots. And that would happen. So drinking during your trading day is not such a good idea. It tends to give you a little bit of artificial courage sometimes, and it can really get you in a lot of trouble. So I would highly encourage you to stay away from the alcohol during the trading day. Number two, don't know your underlying. Okay, we have guys that come through this program that trade everything. I mean, you name it: commodities, bonds, stocks, indexes, futures, forex, whatever, grains, weather. And options are options. But nonetheless, every underlying has some idiosyncrasies and some specifics about it that everyone needs to know. You don't have to memorize every stock in the S&P 500 if you're trading the SPX or something. But there are certain issues that are specific to underlyings that you should be well aware of. And, it's important that we understand basically what we are trading, at least the underlyings. Okay? So, like I said, you don't have to have the encyclopedia on it, but it's probably a good idea to have a pretty good understanding of, how the futures work, what the contract dates are, the delivery, mechanism, all that kind of stuff. So, all right. And the number one of the second round of 5 is not enough capital. Not enough capital. Nowadays, depending on what you trade, it really doesn't take a ton of capital to start, trading, especially relative to other, businesses. But you got to have some capital. You got to have some capital, and you can certainly adjust size based on your capital. You don't have to have hundreds of thousands of dollars or even $100,000 to trade. I mean, we can put trades on for hundreds of dollars, but you do need capital, and you do need to have it allocated properly so you can withstand drawdowns. And even in our program we have drawdowns. So you need to have the capital. You need to have the capital. All right, now. And I'm sure that some of the experienced traders probably recognize every one of these. All right, we got the final 5 here. The final 5 mistakes to avoid. Okay, these are the last 5. That's not my washing machine there, but I can tell you that I've done that before. Not only have I done that with my washing machine, but I've done that with my dishwasher. Because when I bought my first house, I didn't realize that you had to buy specific dishwashing soap. I thought you could use the kind of stuff that you wash dishes, the dish soap. So I put dish soap in my dishwasher, and I had a situation look a lot like this, let me tell you. So for those of you that know that, keep that. Don't put dish soap in your dishwasher. You got to go buy special dishwasher soap. All right. So anyway, these are the final 5 mistakes. Number 5. And this is for option traders now. Some of these don't understand implied volatility. Okay, don't understand implied volatility. The price of options are driven basically by 2 things: price movement in the underlying and implied volatility. Okay, the price movement in the underlying is going to be the primary driver. Okay, but let me tell you, implied volatility is a close second. And you can understand and do all sorts of stuff with the underlying and watch the underlying, but if you don't understand what drives implied volatility and how it behaves, you're gonna be scratching your head as to why your P&L is doing what it's doing. And believe it or not, there are a lot of option traders out there that don't really understand implied volatility. And I'm not talking about option traders that are, new guys or guys that are even trading, on their own. I mean, they're guys that I knew that were working in banks that didn't really understand implied volatility, that were trading their book. So I'm sure that's probably not the case much anymore, but back in the 90s, that was the case. So, understand implied volatility if you're an option person. All right, number 4, theta. Don't understand theta. Options are a wasting asset. Okay, they have a finite lifespan. And what that means is they decay over time. The value of them goes down over time, okay? Or part of the one portion of the value of them goes down over time. And how that behaves and how that works is going to have a huge bearing in how your bottom line plays out. Our strategies are designed around capturing and taking advantage of this along with other things. But this is one part of how we make our money, is understanding how this data works and how it behaves in different environments and across different strikes and things like that. So if you want to make a mistake, don't understand or try to worry understand about theta. Number 3, forget the model changes. And that's a model. We're talking about our option model. She's a model. We're talking about, we got a different model though, but she's changing. But when we run an analysis graph, okay, when we have a position on, and again, I'm referring to options now, okay, it's going to take a picture of our position. It's going to give us a nice picture of our risk, of our potential reward over price and time. What that is, though, is a snapshot. You can think of that as a camera shot taken in a very specific time in a very specific place, that place being price. Almost instantaneously, if you took another picture, it would look a little bit different. Okay? The point is that the model, if we start to change any of the inputs, okay, the output, which is our risk analyzer, is going to change a little bit. So you got to recognize that, as the environment changes, and the environment is price, time, implied volatility, those are the main 3, that those are the 3 inputs, one of the 3 inputs, or 3 of the 3 inputs, it's going to change your output, which is how your performance graph is going to look. So, I've had a lot of people that look at their analyzer, the graph, and they'll say, wow, this looks great. And then they don't look at it for like 4 days, and they'll wonder why everything's different. So that thing's going to change. So you have to keep that in mind. And most guys do, but you have to remember that. And it can change really, really fast. In 2008, when the markets were cratering, back in the fall, we had tremendous changes in our model. Not only was the implied volatility moving by, huge amounts, but the underlying was as well. But the interest rates were changing. If you remember back then, interest rates were moving, which is typically a very, very constant input into the model. But it was changing then. So we had these 3 inputs that were just moving like crazy. Well, you could imagine if you've got such variability in your inputs, how confident you would be of the output, which is the performance profile of your positions. So, we were certainly looking at moving targets back then when it came to our risk evaluations and stuff like that. So. So anyway, that's kind of the extreme, but in all cases, it does change a little bit. It does change a little bit. All right, number 2, don't worry about slippage or volumes. Don't worry about slippage or volumes. That guy's about ready to step on a banana peel and slip. In all instruments, you're going to have slippage. You're going to have the difference between the bid and the ask. Some's more, some's less. Some instruments are more slippage. Things that are not traded very much, you've got wide spreads between bid and ask, and some where there's tons of volume, you may be less. The point is that slippage and that volume is going to be an indicator of how difficult it's going to be to get in and out of your positions. And the difficulty, the amount of slippage that you give up, that difference between the bid and the ask, is obviously going to be a huge determinant of your profit and loss. So, this isn't a big deal with a lot of, like I said, a lot of highly traded products, SPX, OEX, some of the indexes, a lot of the highly traded stocks, at the money stuff like an Apple, Google's, and IBM's, and all, those types of stocks. But some other stuff that's not traded as much, thinly traded stock, thinly traded futures, that can be an issue. So, keep that stuff in mind when you're trading. All right, the final mistake that we want to avoid is, and here's our shameless promo, don't sign up for the Discover Options Mentoring Program. This is our shameless promotion, but this is our guys. And I think between the 4 of us, we've got hundreds to thousands of years of trading experience. Now we don't have thousands of years, but get a good education in this stuff. And if you're an options trader, it's cheap insurance. Okay, we've got a pretty good mentoring program here. We've been around a long time. I know those guys there, between the 4 of them, we're looking at 50 more plus years, more than 50, probably 70 years of trading between the 4 of those at least. So there's a lot of experience there, and we've all had these same mistakes. We've all made these mistakes at one point. So give us a look anyway. But hey, Bob, how are you? Yes, thank you. So in conclusion here, we're going to wrap things up. Learn all you can before you start, trading. Okay, that goes without saying, sort of. Establish rules and just sort of stick to them. Okay. Don't reinvent the wheel. You don't really need to. I know guys are out there that are really smart and can do that and come up with their own trading systems and their own algorithms and all that kind of stuff. But there's stuff out there that works. I mean, some of the best businesses out there, really, the most successful businesses weren't the guys that actually invented the business. They were the guys that figured out, what works and just did it. And that's kind of our motto here is let's see what works and just use it. I'm not here trying to, I'm not smart enough to kind of come up with a new trading system. And then get reputable help. And I got reputable bolded in there. There's a lot of information out there. It's everywhere. It's on the internet. It's you name it. It's everywhere. Books, everything, magazines. But make sure it's reputable. And I guess that's sort of quality. It's hard to how do you find out if they're reputable or not? Well, ask a lot of questions. Find out the experience of the guys, if they're trading it. Are they trading with their own money? Are they managing, how long they've been doing it? What kind of success are they having? All that stuff. So just like anything, just if you're going to buy a car, buy a house, or hire a guy to, you do some work for you, you got to get somebody that's hopefully reputable and qualified. So but that's it. So here I am, and I got a couple of questions here, but here I am. And again, I mean, if you have any comments or questions, you can always reach me at both these emails, steve@discoveroptions.com or steve@placapitalmanagement.com. Those are both my email addresses. I'd love to hear from, again, if you got any ideas for webinars going forward. Otherwise, I'll just, we'll have new stuff anyway. We'll do a lot of strategies, a lot of theory, and but if there's something specifically anybody has, send me that email. Let me see, Rob, is this list of mistakes printed anywhere on the site? I don't think so. You can go over to discoveroptions.com. I don't think this list is specifically put up there anywhere yet, but this webinar will be posted, and then I think I'll have to see if we can get a list out there. If maybe somebody can put that list up, but you can certainly get it off the webinar, the recorded version. I'm not sure if you can download the PowerPoint or not, but that's it. So I don't know if there's any questions or not, but I'm here. If there are, I'm happy to hang. Otherwise, we look forward to talking. We look forward to talking to everybody in a couple of weeks, whenever my next webinar is. I got to look at my calendar. I think it's in February sometime. I see people typing. This is this new technology. Okay, we got. This is like this new thing, so I can see people typing. So I'm going to kind of hang here for a sec. Thanks, Paul. Here's where the recording. Jim Graham put up the website for where you can get the recording. So that's, like I said, that's usually, they're pretty good about getting that up there. So that'll probably be there I'm guessing by the end of the day, but not for sure by tomorrow. So here he is. He's coming with the time. I can see Jim typing. Gives you a lot of information here. Okay, we've got three typing. Okay. Good. Yeah, please send those ideas, Bob. I'd love to have them. Thanks, Dirk. And I think that's going to be about it. Unless I see, if you send the PowerPoint to the reps, they can call it. Okay. They can call into the rep and they can send. Okay. Though, I guess if you guys, if the reps can send out the PowerPoints. So if there's some requests on that, if you contact the company, they can get that information sent out to you. So we'll for sure get anything you need to you. So we'll make that accommodation. No worries. Anyway, I'm glad to do this. I thank everybody for being here. I know your time's valuable. So I wish you all well. I look forward to the next webinar, and have a great day. Thank you.